Let's learn another reversal pattern. It is called the head and shoulders pattern. The head and shoulders top. As the name suggests, it is made up of a left shoulder, then a higher head, and a lower right shoulder. In a head and shoulders top, the price of a bullish asset pulls back and then rises to a level above the initial top. The first and second tops are the left shoulders and the head respectively. The price then falls again, finds support, rises again, and then falls, forming the right shoulder. The level where it initially fails to cross is known as the neckline. The neckline may be a downward or upward slope or horizontal. In our experience, a downward slope neckline increases the probability of a reversal. In a head and shoulders top pattern, we should set a short order below the neckline. You should measure the distance from the top to the neckline and then estimate the position of taking profit. In most cases, this should be 1 to 3 times the distance from the top to the neckline.
If you want to watch the full version of the video, you can go to TradingLive or download the TradingLive app. Share it to your friends and learn for free.